Great, great. Thank you so much. So great. Now I've seen what we shall be doing. Great. Okay. All right. So we are doing a very, very important topic which must come this semester, whether you like it or not. There are so many students who will always keep on asking me, Mwalimu, how is the leakage like? And of course, I'm not an examiner, but I know there are topics which will never miss. Now, somebody, when they talk about marginal costing, what comes to your mind? What is a marginal cost? A marginal cost is a variable cost. So anytime you hear the word marginal costing or marginal cost, you shall always think about what here? Variable costs. So you simply account for variable costs first. Anytime you hear about absorption, the word absorbed, it means that you are absorbing everything. So you're absorbing what and what here, somebody? Yeah. Anytime we talk about absorbed, we are absorbing everything. That means that we are taking variable cost plus what here, somebody? Fixed cost. That is how you get to differentiate between the two methods of what here, two methods of costing. I should only be left my head only. They should only be able to see my head here. Only here. So you can make it tiny. No, we're going to make it very tiny. That's too big. He has understood already. So overview here. We have marginal costing is an approach used by some businesses that focuses only on the variable cost per what here, somebody? Per unit. Treating fixed cost as who? Periodic costs. Variable cost refers to the extra cost in a card each time a unit is produced. Fixed costs are in a card regardless of production volume and are charged in full to the period in which they occur. Very, very good example is this very classroom of ours. Assuming we will be able to get just 5 students the whole semester. If we get only 5 students the whole semester, can we go down on our knees and bargain with the landlord? Tell the landlord that the semester was very, very poor. Please charge us 5,000 rent only. No. So in this case here, rent is always what your fee? Fixed. It doesn't change. It doesn't increase. But variable cost will always keep on doing what here? Increasing. I can see the word extra for variable what here? Variable cost refers to the extra cost in the card. Each time a unit is done, what you produced. Assuming, for example, we are giving you past papers. So every new student who comes on board gets a past paper, right? So that past paper that you guys got, I hope you got some past papers. How much does each past paper booklet cost? Maybe 50 shillings. So every time we get a new student, we give them a past paper. So the cost goes up by 50. So if you've got 2 students, then automatically the past paper cost will be 100. If there are 3, 150. So I can see extra costing. So anytime we talk about variable cost, it refers to the extra cost in the card each time a unit is produced, and the fixed costs are in a card regardless of what year, how many units you produce. Even if you produce 0, fixed cost must be in a card. And that is why we call fixed cost what year? Periodic. Remember, all fixed costs are periodical. What do you mean, Mwalimu? Like rent, we don't pay rent on a per unit basis. We pay rent, in this case here, every month. Periodical. Salaries, we pay salaries on a monthly basis here. So variable production cost per unit, which we shall always be looking at. Anytime we talk of marginal costing, we've said we're looking at variable production cost per what year per unit. So the cost elements for production purposes, we need materials, we need what year somebody labor, and then we have what we call variable production what year overheads. Those are the 3 components for us to be able to get what we call marginal cost per what year per unit. I can see so many of you who are trying to write down. Remember, you have this booklet. Do you have it? Yeah. I mean, there are students who will always tell me that when I write, I understand best. Is that true? We shall overcome. So how do we get marginal cost per unit? We shall be taking direct materials DM, DL, and the variable production what year overheads. We must always remember that. Then we have here marginal costing principles. So under marginal costing principles, we are told here that variable production costs are treated as product costs. Those costs which are treated as product costs are always included in inventory valuation. They are inventoriable. Inventoriable. We include them in calculations of our inventory. Fixed costs shall be left in our inventory valuation, and they shall be treated as what here, somebody? Period costs. They are deducted in the profit statement for the period. Number two, we shall be calculating what we call contribution. Contribution is a key concept in marginal costing. It represents the amount available to cover fixed cost and generate what here, somebody? Profit. And the most important thing you're supposed to always remember about our contribution, what we shall be calling contribution margin, is the formula. How do we get contribution margin? Selling price minus what here? Variable cost. So anytime we talk about this contribution, we shall be taking the selling price minus our total variable cost. And the most important thing, ladies and gentlemen, that we should be able to really appreciate is this example one, and then we go to our past papers. Example one. So example one, they've given us a very good scenario. If you understand this, we shall be able to answer all questions on our past papers touching on marginal costing. So this is a very, very important example. And if you're able to understand it very well from the beginning to the very end, you will be able to get my present this evening. So we are told scenario. X like Safaricom produces, X like Safaricom, just 1 minute. Yeah. Let me see what these guys are saying. Perhaps they can't see. Share them with me kindly if you are able to get them. Yeah, Egra, I'll be able to give you these notes. I have a new system. I'll just figure out how to share. For now, let me close the chat. So they've given us a very good scenario of producing a product known as what here? Desks. To produce this desk, we need direct materials like timber. And they're telling us we need direct materials how many kgs? And each kg is worth how much here, somebody? 3. We need direct labor, 4 hours, each at 2 per hour. We need variable production overhead at 5 per unit. We have fixed production overhead, 20,000 per month. We have average production, 10,000 units per month. Selling price per unit, 35. And then we have what they are calling the variable selling what here called of Kenya shillings 1 per unit. Then we have the fixed selling cost of 2,000 per month. Then we have production and sales data. I have 2 months. In most cases, in your past papers, you'll always be given 2 months. So we have data for January. We have data for February. Required, they want us to prepare a cost card using marginal costing. Then we prepare another cost card using absorption what here called costing. And then we do profit statements for January and February using marginal costing and absorption what here, somebody? Costing. So we start with cost card using marginal costing. So right there, cost card dash marginal costing. Cost card, marginal costing. Cost card, marginal costing. Now I want to start writing. Very good. No. Once I'm here, so I want to know whether my online students are they able to see this whiteboard of mine, MA? Okay, so share. Okay, are they able to see MA whiteboard? It's called Management Accounting Whiteboard. So we are writing, ladies and gentlemen. We are writing here. So we are writing in this case here cost card. Yeah. So cost card. Okay. So we have here cost card. And the method we are using here is what here, somebody? Marginal costing. Marginal costing, you underline very well. So when you talk of marginal costing, what comes in this case in our mind? I gave you 3 ideas here, 3 cost elements. Which cost elements are we looking at? Direct materials, direct labor, variable production, what here? Overhead. Those 3 only. So right there, direct materials, For me, it's called DM. So direct materials, are you able to remember the kgs? How many kgs do we need? 4 kilograms. Each at what here, somebody? 3 per kilogram. So in terms of shillings, what do we have here in terms of shillings? It is 12, isn't it? Yeah. So that is the first marginal cost, the incremental cost. Should we make one desk? We need materials. Yeah. What else? Direct what here, somebody? Direct labor, isn't it? So next we have here direct labor. So direct labor, have they given us hours? Have they given us hours? Let me stop sharing a little bit. And then I pick up this share. I want to share the whole screen. Sorry, I'll be able to answer that. So I want to share the entire screen for me to get this. Yeah, so that when I'm sharing now the entire screen, I can be moving between my, where are my notes? We shall overcome, don't worry, it's a new technology. Don't stop sharing. I just want the notes. Are you able to see them? We shall overcome. Oh, so every time you must go back to. You want sharing, right? Oh, we shall overcome. So I just want the entire screen. And then I should be able to flip through. No worries. Let me just try it out. No worries. Imekubali. Okay, so great. Alafu pia inakataa. Itakubali better. No worries. Let me just figure out. So in terms of, in this case, ladies and gentlemen, in terms of direct labor, I can see my direct labor. Where is my direct labor now? Direct labor, it is 4 hours. Each at how much? Yes, somebody. Each at 2. So direct labor, what do we have here for direct labor? Direct labor, we have in this case here direct labor, we have 4 hours, each at 2 per hour. So which gives me how much in terms of direct labor? 8, isn't it? Which gives me 8 like that. Now you guys should be able to help Mwalimu here. This is quite a technical system. So direct labor, what do we have here? We have a 4 hours. Yeah, we have in this case here 4 hours. Which one? Outside. So 4 hours times what here? Somebody 2, giving me how much here? Somebody 8. And then apart from this, we have variable production. What here? Somebody overheads. Please write this in full. We have variable production overheads. Have they given me this figure in full? How much do we have there? 5, 5. So in this case here, 5. So if you add this, you will be able to get what we call variable production cost per unit. So we have here the variable production cost per unit, giving me how much, ladies and gentlemen, at the end of the day? 25, right? Now the question is, remember we are using marginal costing. We will ask ourselves, do we have other variable costs apart from the production ones? We have what they are calling what here? Variable selling. So because we want to account for all costs. You see here, we've been able to account for those costs that we need, variable costs that we need, just for purpose of production. So post-production, after we are produced, we need to sell them, isn't it? We need, in this case, to distribute them. We only have what we are calling variable, what here? Somebody selling. So we have in this case here other variable cost mentioned there, other variable costs. So other variable costs, which variable costs are we talking about here? They are called what here, somebody? Variable selling, isn't it? So variable selling. Variable selling. So we have here variable selling. Variable selling. So variable selling over how much? Variable selling over how much here, somebody? 5 bob. Or just 1 shilling, isn't it? So then the total marginal cost will be what here, somebody? 26. Total marginal cost will be 26 like that. Total marginal cost will be 26. 26. Why is it okay? 26 like that. Thank you so much. 26. Now, ladies and gentlemen, please, as we look at what is happening here, I want us to do Roman 2 of this question. Give them the cost card, but this time around using which method, dear somebody? Absorption. So mention there, cost card. Wow, this is crazy. This is crazy, but we shall get used to this. It's technology. Cost card. No. Cost card. But this time around, we are using what method here, somebody? Absorption. We are using a method called absorption. What here? Absorption costing. Absorption costing is also called full costing. This is also called full what here? It's also called full costing. It's also called full costing. Full costing. It's also called full costing. So if it's full costing, we have already mentioned that we shall take variable production cost plus fixed production what here, somebody? Cost. We shall repeat everything that we have here. So we shall start right away with the direct material. Everything that we have here, ladies and gentlemen, we have here direct what here? Direct material. Very good. So we have here direct what here? Direct materials. So we have here direct materials. So direct materials, how much do we have here? The ones who gave me the 4 kilograms. 4 kilograms, and each kilogram was going for how much here, somebody? For 3 bob. So 4 times 3, this gives me how much here, somebody? This gives me 12 like that. Apart from direct materials, in terms of our costing, we have what we are calling direct what here, somebody? Labor. So direct labor, do you remember the 4 hours? So we have here 4 hours, and each hour goes for how much? For 2. Which will give me what here at the end of the day? A. And then we have the variable production overhead. Variable production overhead. You great students had already given me an answer. Variable production overhead was what here, somebody? I'm being given a figure of what here? A figure of 5. Is that okay? A figure of 5. Apart from this, do we have any other costs? No? Yes, we do. This full method. Variable? No, you cannot mix production and selling expenses. Not possible. Fixed production. So we have here fixed production. We have here fixed production overhead. So fixed production overhead. So this fixed production overhead, are you able to see a figure somewhere? Are they able to see a figure somewhere? This fixed production overhead, are they able to see a figure somewhere? Abracadabra. Are they able to see a figure somewhere? Fixed production overhead, are they able to see a figure somewhere? You can see here, we have fixed production overhead. But they're giving us 20,000 per month. And yet I'm doing cost per unit. So then how will I change this fixed production overhead to a unit cost? We divide by production units, isn't it? Yeah, we divide by production units. Are you able to see the number of units in this case here we are going to produce? How many? Do we use this 10,000 here, or shall we use here production and sales data? 10,000 is average, isn't it? Because basically, what this student is telling me, ladies and gentlemen, is quite important. What this gentleman is telling me here is this. What this gentleman is telling me here is this. This gentleman is giving me a very good concept here that we are absorbing this overhead. And when you are absorbing an overhead, you take the budgeted overhead over budgeted production. So if they want me to calculate what we call here OAR, if they want me to calculate OAR, if they want me to calculate, do you remember the concept of OAR? Sorry. How do we get this OAR? If they remember, to get OAR, we will take budgeted overheads. Don't forget this. Budgeted overheads, budgeted overheads, budgeted overheads. We divide this by, if you're absorbing this using units, we divide this by budgeted units. Budgeted units, yes. Budgeted production units, yes. So you see, budgeted is the same as expected. Expected is the same as average. So in this case here, the whole month, we are budgeting to get how much here, somebody? 20,000, isn't it? Out of average units per month, which are coming to how much here, somebody? Which are coming to 10,000, which then will end up giving me how much, my good students here? 2 per unit, isn't it? Shillings 2 per unit. Shillings 2 per unit, like that. Shillings 2 per unit. So in this case here, the fixed production overhead, we have 2 bob. 2 bob. We have 2 shillings. And the moment I have that now, ladies and gentlemen, I'll be able to give my examiner, here, I will be able to give my examiner here the total cost per unit. And remember, these are basically what here for production. For production. So the total cost per unit, production cost per unit, this one here will end up giving me how much if you're following? 27. So this is really, really important. Do we have other costs apart from just this production cost? Is the question, do we have other costs? Just check, do we have other costs? Yes, we do. We have the selling cost, isn't it? Are you able to see the selling cost, somebody? Yeah. So the selling cost that we happen to be having here, we have the, you can see, ladies and gentlemen, here that we have, you can see here, what do we have? We have variable selling. Variable selling costs are how much here, somebody? It's 1 per unit, isn't it? So they should have shared this new technology. We have to get used to it. There is no other way about this. I'll be able to tell you why this is very important for us. So the other costs, these are post-production costs. After we produce, we need to sell these units. And to be able to sell them, we have variable selling at 1 per unit. And then we have fixed selling, which they've given us 2,000 per what here, somebody? Per month. So they give us 2,000 per month. What do we need to do? 2,000 per month. So if I want, I can divide them by the 10,000 to make it fixed cost per what here, somebody? Per unit, yes. So we have 2 costs which are very, very important here, which are coming here to put up here. Not this one. Yeah. So we have this. Yeah. So we have other costs. So mention there other costs. Other costs. So other costs, basically these are post-production. They are non-production. So we have in this case here what we are calling variable selling. So we have here variable selling costs. This one I've got no problem at all because they have given me 1 shilling here per what here per unit. And then I have the fixed what here, somebody? we have the fixed what here, somebody? Fixed selling. So fixed selling, they've given me 2,000 per month, but fortunately, I know that for the whole month, I expect in this case here to deal with how many units here, somebody? 10,000. So 2,000 divided by 10,000 gives me what figure here, somebody? 0. What here, somebody? 0.2. So if you add, you are able now to get the total production and non-production cost. Total production and non-production what here? Cost, which will end up giving me what figure if you're able to follow? 28 point what here, somebody? 28.2, which will end up giving me 28.2 like that. So I would want to repeat this, ladies and gentlemen, in a way that all of us will be able to appreciate what we're talking about this evening. If you go to an exam, and you'll be able to see this in your exams, yeah, and then you realize that your examiner wants you to get marginal costs. Your examiner wants you to calculate marginal costs. What will you do? First of all, we will start with the marginal production costs. There are three. Marginal production costs are three. What do we have here, somebody? Direct material. Then we have direct labor. And then we have variable production. What here? Overhead? Overheads. Get that. After that, because these are only variable costs, after production, the only other variable cost we think about will be variable what here, somebody? Selling. So you come and give us variable selling. Variable selling. So variable selling, we have that. Then we'll be able to get our total marginal costs, which will be marginal production cost and the marginal non-production cost. Should they tell us to give them the full costs or the absorption cost, we shall be able to include everything that we have here, including what is some of the fixed production overheads. Fixed production overheads must come, and any other fixed cost must as well come there. Now, look at number 3 of this question. So number 3 of this question, they want us to do something very beautiful. Number 3 of this question, they want us to do something that defeats so many students, and yet it is the easiest. What do they want us to do here? Number 3 of this question. Number 3 of this question, what they want us to do, ladies and gentlemen, here, what they want us to do, ladies and gentlemen, here, is to prepare profit statements for January and when? February, using what here, somebody? Marginal costing. Let's start with marginal costing. You understand this? This will be the end of our session. Yeah. So they want us, ladies and gentlemen, to be able to do what here? They want us, ladies and gentlemen, to be able to calculate profits generated in the month of January and February. First of all, starting with what here? Marginal costing. Marginal costing. So then the very first thing you will do, look at this month of January. The month of January, we are going to produce how many units here, somebody? 11,000, isn't it? And then we sell how many? Are you able to see closing inventory? How much is the closing inventory for January? 2,000. Because you see, we are producing more, 11,000, but we only sell 9,000. So then we shall be left behind here with how many? 2,000. That automatically marks what here? Our closing inventory. So when we go to the month of February, what will be the opening inventory of February? It will be the closing of January, isn't it? So that marks the opening of February. So then how many units will we be having available for sale in the month of February? 11,500, because we are taking what we began the month with, 1,000, plus what we produce in the month. So 2,000 plus 9,500 gives us 11,500. And then we sell how many units here? Everything, meaning that closing in inventory for February is how much? 0. So then the very first thing you need to do whenever you see an examiner telling you to do a profit statement, marginal or absorption, you must give us an inventory movement table. That is the first thing you need to do. Come here and give us inventory movement table. So come here and give us the inventory movement table. So our inventory movement table, how will this look like really? Very easy. Very easy. So our inventory movement table, this is how it will look like. Very easy, very easy. So we have here inventory movement. I don't want this. I want this. Let me just go up a little bit. Nope. What happened to this? Are you able to remove it? All right. That one is good. Okay. Thank you so much. So inventory movement table. So in this inventory movement table, what do we have there? So we have here inventory movement. Inventory movement table. So in this inventory movement table, this is what you will do. We have our months, January and when? February. We have opening stock. I like calling them stock. We have opening stock. And then we have a production, what we produced. Then we have, in this case here, our units done what here, somebody? Units done what here, somebody? Sold. And then we have, in this case here, our closing what here? Our closing stock. You can call them inventory. I prefer the old school. I prefer calling them what here? Stocks. I prefer calling them stocks. All right, great. So first of all, we feel what the examiner has given us in the table. So January production was how many units here, somebody? Oh, I'm alone. 11,000, isn't it? How about units sold in January? 9,000, isn't it? 9,000. How about February production? February production is 90 from the 9,500, isn't it? How about units sold in February? 11,000. So 11,500. So 11,500. So which one is the duster? Is it this one? Yeah. Oh, I go back, using which one? You guys are brighter than me. The rubber is here. No. Where I'm choosing the pen? This one here. What? Or the pen itself? This one here. Next, this one here. Ah, great. So once I do that, I'll be able to rub this. Yeah. 11 watt here. So then I can now continue, right? Thank you so much. So 11 watt here, somebody? 11,500. Let me see. Thank you so much. 11. I'm again spoiling. 11,500. Thank you so much. So you see, the examiner has given us those numbers, isn't it? So we start with the month of January. Not unless in this case here you are a devil worshipper. You see, this is when we are beginning our production, isn't it? You can't tell me that you were given a business with stocks inside. Not unless the examiner tells you exactly that January you are starting with opening stock. So basically January opening stock will be nothing, zero. That's how business is, isn't it? And then in this particular month we produce 11,000, but we end up selling how many? So then we are left with how many behind? 2,000 will be our closing stock. The closing stock of January automatically becomes what? Opening for which month? February. So opening stock here is 2,000. Thank you so much. Remember, goods available for sale. You take opening stock plus what you produce. Yeah, so 2,000 plus 9,500, that's what we have available for sale. And then we sell how many? We sell 11,500, isn't it? So in this case here, closing stock will be zero. The moment you get this stock movement schedule, you are good to go. You'll get the entire question right. Is there anybody who has a question for me? All right. So then I'll be able to, now at least this is agreeable. So then we come straight away and mention there, profit statement, marginal costing. Profit statement, marginal costing. So we have here profit statement. And this time around, we are using what we are calling what here, somebody? Marginal costing. So when we get used to this, we shall be doing the 2 months concurrently, January and when? February. So January here and February here. But because we are doing this for the very first time, I request that we do what here, somebody? Just 1 month alone, isn't it? We do the month of when? January alone. But the second question from our past papers, you will see, we shall be combining both January and February side by side. See, it always easier that. So it's a profit statement. So when we are calculating profits, we normally begin with what? Sales, yes. Yes, sales. So come here and give us our sales for the month of January. From the stock movement schedule that you did, are you able to see how many units we sold in January? 9,000. So how will I be able to get sales for January? Take the units we sold times who? Times the selling price per unit. Have they given us the selling price per unit? How much? Most of them are not talking to me, especially the online students. They are not talking to me. In this case here, we have, these ninjas have given me the selling price per, they must have given me the selling price per unit. They must have given me the selling price per unit. They must have given me, you can see a selling price per unit is how much? 35. You know, that is a mark in management accounting. This is the easiest subject to pass because everything you pass here is a mark. So how do we get sales revenue? We take price times quantity sold. Thank you so much. Thank you so much. Thank you so much. So I stop share here. I'll be able to know the shortcuts very, very soon. So then I pick, this one like that. So you have been able to tell me that, Mwalimu, you know what? 9,000 times what here, somebody? 35. Which then will end up giving me how much? 315,000. So we have here 315,000. Thank you so much. 315,000 like that. Now remember, you're the drivers here. Having taken care of the sales, what do you think will be the next thing to be done? The cost of sales, isn't it? So we less cost of sales. But now you have to be very, very wise. Cost of sales, remember we're using which approach? So we are only going to account for marginal costs. So you write into brackets here, MC, MCP, marginal cost of production. You can write in the full, given that you are doing it for the very first time. MCP. Come on, remember our DCP inaingia kabisa, MCP, marginal cost of what here, somebody production. Marginal cost of production. So then can you kindly give me the formula of getting cost of sales? You are the best accountants ever. How do we get cost of sales? Opening stock or opening inventory plus purchases minus. Thank you so much. But remember, in management accounting, we are dealing with manufacturing. We are not procuring to sell. We are producing these things in turn. So let's repeat again. So there will be nothing like purchases. So we start with opening inventory. We add manufacturing costs, which we call production costs. And then we let what in inventory. So in this case here, we underline this. So we start right away with opening inventory. So please go to your stock movement schedule. Tell me, what is the opening inventory in the month of January? 0. Actually, this one, there is nothing even much like doing any computations. So opening inventory, I talk of what here, somebody there? 0. Because 0 multiplied by any number is 0. And then we shall be able to come and add what? We add the production costs. So production cost will always be pegged on the number of units that you produced. In January, we produced how many units? Look at the inventory movement schedule. 11,000. But you see, I want to convert this to money. So I'm converting this to money by multiplying this with the MCP. Marginal cost of production, is it 26 or is it 25? Patapotea. 26 or 25? I think 26 had a selling component. It had a selling component. And you see selling cost will come down here. You see here we are at the MCP production. And there are only 3 production costs: direct material, direct labor, variable production, overhead. So in this case here, never value stocks by including a selling component, administration component. Those are beyond production. Here we are valuing everything at what we call marginal cost of what here somebody production, which you guys were able to give me as what here somebody has 25 years. The 26 is marginal cost of production and selling. 26. So this would be 25. So 11,000 times 25. I can see this. Just a minute. I can see this one. So many online students are chatting things here. 11 new chats. That's very, very bad. They're giving me answers. Kennedy, brilliant. Wow, this is great. Great. But now there is one disadvantage with this kind of a system. You guys will be able to read my inbox messages, isn't it? So if I have a pretty girl here telling me, Mwalimu, I love you, international disaster. International disaster. So 11,000 times 25 gives me how much here, somebody? 27? 275,000. 275,000. 275,000. Thank you very much. And then we come and less who? We less closing stock. Do you love calling this stock or inventory? Whichever, isn't it? Any. Sorry, we shall overcome. Don't worry. Don't worry. Don't worry. Yeah, less closing stock. And then, of course, whenever we have some of these mishaps, we shall not scream too much. What of when will you be having your brand new Mercedes-Benz going down? We shall overcome, right? So closing from your inventory movement schedule, remember we are in which month? January. What is the closing stock of January? 2,000. 2,000. And do we know the MCP for the whole inventory item? 25. So this will give me how much here, somebody? 50,000. And remember, this is to be subtracted. This is to be subtracted. This is to be subtracted. So then come and combine the 3. Combine these 3 items at once. So it will be 275,000 minus 50,000, giving me 200 what here, somebody? 225,000. So remember, you're supposed to less all this from the 315,000. You less all this from the 315,000. This is your cost of, say, this 90,000. So we have here 90,000. What name do we give to this 90,000? It shall be called a gross contribution. Gross contribution. Because somewhere we read and said, whenever you take sales minus variable costs, you get something we call contribution. So gross contribution here is 90,000. 90,000. That's gross contribution. So, but I want net contribution. So how will I be able to get to net contribution? We less other variable costs, which are now non-product. Like which ones? Variable selling. So you mentioned there less other variable costs. Less other variable costs. Basically what we are calling non-production. Non-production cost. And you're going to learn that there are 3 of them. We have in this case here variable selling, variable administration cost. We have variable distribute. All those are not related to production. But for simplicity purposes, the question you are handling has only one non-production variable cost, which is variable what here? Variable selling. Variable selling. So in this case here, we less. So we are calling it variable what here, somebody? Variable selling. Variable selling. variable selling costs. So variable selling cost, what I remember they gave me on the cost card was 1 bob. So, but I want total for the month of January. So the question is, will I multiply this one with 11,000 or one with 10,000? Abracadabra, patapotea. Oh, 9,000. Is it 9,000 or 11,000? Why 9,000 and not 11,000? Because this is based on what we sold. So it should be 1 times 9,000. Should be 1 times 9,000, which gives me what here, somebody? And that is the only variable expenditure, non-production expenditure that we have. So you subtract. Once you subtract, you'll be able to give us, ladies and gentlemen, what we call what here? Uongo. Net contribution. Net contribution. Net contribution. So you give us what we call the net who? The net contribution. So the net contribution will be 90,000 minus 9,000, which gives me how much here, somebody? Which gives me 81,000. Thank you very much. Which gives me 81,000. So after we get this net contribution, as you're going to see later on, anytime we talk about profit, please listen. Profit, I'm so sure those of you who are very young, you must be remembering this one here as a pie in high school, which was 22 over what year? Or a 3 point what year? Oh, in business, whenever you see pi, it stands for profit. And our profit will always be total contribution minus now what here, somebody? Fixed cost. So once you've been able to get net contribution, the next thing will be for you to come and subtract our fixed what here? You subtract fixed costs. So you come here and less fixed cost. So I'll be able to pull my board a little bit up. Now I'm becoming a superstar. I'm a fast learner. Yeah, great. So we less, no. I have to touch the pen. Less, yeah, fixed cost. So less fixed cost, I can see we have 2 fixed costs there. Which costs are those ones? We have fixed production and fixed selling. So we have here fixed production. We take it as is because we are not absorbing here. So fixed production in gap is somebody? Oh, I'm alone. 20,000, isn't it? 20,000. And then we'll be able to come and subtract here fixed what here, somebody? Fixed selling. So fixed selling over how much here, somebody? I'm only hearing basis, only gentlemen talking. All our girls around, you've also switched to bass. We shall overcome, isn't it? I need a blend of voices. So 2,000. Which then when we subtract here, it will be 81,000 minus 20,000 minus 2,000, which will end up giving us how much, ladies and gentlemen? 59,000. What name do we give to this 59,000? That is the end of our statement. So we call this one here net what here, somebody? The net profit like that. The net profit like that. Net profit. So this whiteboard is very, very powerful. Later on, I haven't used it. I'm using it for the very first time. But now I can easily convert this to a Word document typed. And then I share with you the notes immediately after class. It's a very, very powerful model. Very, very powerful model. Yeah. So net profit 59,000. So I want you guys to do me a favor. So I want you to go ahead and make a profit statement, marginal costing, but this time round for which month? February. Is this something you can do by yourself, I mark? The online guys, let me see your charts. Online guys, they are 30. I know they're struggling a little bit. Net profit, Kennedy, you must be a very good student. Caroline, you're gone. I remember this lady. Great. Great. So now you're doing for which month? For February. They're now doing for February. Please, online students, ensure that you are asking questions. When I'm not making sense, don't fear to call me nonsense. Yeah, so long as in this case here we get connect. That is the most important thing. So we are doing February, and if you can do it without looking at my January statement, then I give you a present. The format. So this student is asking, maswali yenyewe. All right. So then they want the question itself, which is your right. So I will be able to come here. Yeah, yeah. So we come here like this. Oui. Yeah. So I come here, the question itself like that. I share. So if you want to see the whole question, it means I have to condense it a little bit. Are you able to see like from the back? Oh, you must be having very good eyes. So what are we doing? We are doing number 2, prepare cost card. No, we are doing number 3, prepare profit statement for February now, using marginal costing. And then remember, the students who are with me here physically, the biggest strength that you have is discussing amongst yourselves. The very best gift you can always ask for from God is to have a neighbor who talks to you. That is a gift. That's a gift. So remember the sales units in the month of February, how many are they? 11,500, isn't it? And this was a good examiner. He never told us that in the month of January or February, the selling price is going to change. If you get a bad examiner like myself, I'll always tell you that in the month of February, selling price will increase by 10%. I will hide that one somewhere there. That's a sadist of an examiner who is wishing students what year? Fail, which is very bad, isn't it? That's not me. I'm not a sadist. I'm never a sadist. Mhm. Please, I would want to see the three of you talking a little bit here and there, please. And then the Muslim students, it's important. We also take this as a break for prayers. You can just do like 5 minutes prayers and then you come back. So the online students for the month of February, how much do you have online students? Let's start with the online students. Online students, the month of February, if you are right, we should talk of 81,500. So online ninjas, how much do we have for the month of February? Online ninjas, Zoom kiasi, sorry, I've not seen that. But Caro, already you have that. So it's only Kevin, online students, who got 81,500. 81,500. 81,500. And of course, now with your permission, I will not do that one. I will straight away take you through now the absorption. Are we comfortable, all of us, with 81,500? Umesema no. All right. So let's see where they may have gone wrong. Let's see where they may have gone wrong. So sales is 11,500 times 35, which gave us 4,500. Opening inventory is 2,000 times 25. Unakumbuka February, opening inventory ilikuwa ngapi? 2,000. And it's a full stock item, full inventory, which in this case you're valuing at 25. What do you value at? No, you think 35 is absorption? That is our next method. February valuation nabaki the same. Yeah, so you should have valued this at 25. It's good you brought that argument. Production should be 9,500 at what here, somebody? 25. Closing inventory should be 0. 0. And then don't forget the variable selling, 11,500 times 1. Don't forget, in this case here, fixed production, isn't it? 20,000, fixed selling of how much? 2,000, giving us 81, what here, somebody? 500. 81,500. So up to there now, are we okay? Let's give him 2 minutes. Are you confused? Umeandika tena vizuri hapo. Umeandika vizuri hapo. Marginal costing, profit and loss, month of February, but you used absorption costs. That was where you went wrong. And I'm so sure he's not the only one. If online students were to be very honest, there must be a ninja who got something different. Yeah, you can see Caroline, you're going, me too. You're not alone. Yeah, great. Great. But Caro, I hope you've been able to understand now, right? Caro, my hope is that you have been able to pick this. Thank you so much. Thank you so much. So 2 minutes, please correct very fast. And I also know why this gentleman went wrong. When I asked you to have a discussion with our neighbor here, you said no. You discussed. Oh, same answer. So somebody here must have cheated the other. But we shall overcome, right? We shall overcome. So after this, I'll be looking at a past paper question. Just so that you don't waste time, I would want to read the past paper question for you as the gentleman is doing this. I would want you to be opening that past paper question so that you don't waste time. I'll be doing the December 2024. December 2024, question number 2B. December 20, after I finish. I haven't yet finished this question. But after I finish, I'll be looking at December 2024, question number 2B, be putting that question closer to our chests. Otherwise, allow me to take you through a very important, Dixon Munini is doing something there, a very, very important method known as what we call, what here somebody absorption costing. I love absorption costing because here we are absorbing. We are absorbing what and what? What are we absorbing? Selling. We shall never absorb non-production costs to our inventory units. We absorb variable production cost plus fixed production cost, which already we had calculated in our the absorption cost per unit, was it 27? 28 or 27? Pata potea. Only production costs. Don't add any selling, isn't it? 27. Please look at your table. Look at your table. We had already done that. If I come here, and now I get to share my board. If I come here and I get to share my board, this is my board. I'll be able to show you that the variable production cost was 25. It's becoming bigger and bigger, and I want to simply go down. We are done this. Oh yes, this one here. You can see under absorption costing what we call somebody full cost. Full cost, we have the variable production overhead, which was not overhead. We had gotten in this case here the DL variable production overhead, which gave us 25. And then we came and added the fixed production overhead of how much somebody? 2, which gave us a total cost per unit production only of how much somebody? All the others are non-production. All right. Now let's get ahead and now do this question that they want us to do, which is quite an easy question. So what do they want us to do here? So they basically want us, ladies and gentlemen, what is happening here? I want to scroll this up. Now give me the way forward. You're my teachers. Where? Oh, slowly. Wow. You guys are geniuses. Wow. We should overcome. Yes, I agree. We should overcome. Very good. So then right there, profit and loss statement. Yeah. So we are doing a profit and a loss statement, but this time around we are using what here? Absorption. Just a big word over nothing really. Free mark, it's a P&L. We start with sales. Do you want us to combine the months, or we do first of all separately? We combine, Not at the moment, not now. In the past paper question. For now, let's do what here somebody January. And then from thereafter, we shall now be combining January. So we start with sales. So sales, are you able to remember the number of units here we sold in the month of January? 11,000. 9,000 is what we sold, isn't it? So 9,000 is what we sold. And unfortunately, we still remember the selling price per unit, which was what here somebody? 35. That does not change, isn't it? So then this one will end up giving us what figure? 315,000. The online students, I can't feel you. I can't see your comments. The online students, I can't see your chats. Thank you so much. Now I can see you very well. 315 what here? 315,000. Then from there, ladies and gentlemen, we come and less what here somebody? Cost of sales. But now remember, this time round, we are subtracting what we call the full what here? Cost. Too easy. Full cost. What is the full cost per unit? 20? 28 or 27? 27, yeah. 28 includes this other additional cost like selling, which can never be absorbed to a unit. They are not part of producing that unit. So less cost of sales, of which you start with thanks. Great. We start with opening the stock, isn't it? So opening stock, month of January, how much? 0. Just for our revision, times 20, what here somebody? 27. Just for our revision. So 0 times 27 is not 270. It is 0, isn't it? You know, people could be very tired, right? And then tell me, add 270. Then we come and add what here somebody? Production. we add production costs. In the month of January, how many units are we producing? How many are we producing? 11,000. And we know our production cost per unit. 20 what here, somebody? 27. Our production costs are 27. Because you're using ABS. We are using absorb. Okay, sawa uweka ka selling cost hapa ndani unanyoroshwa, unaanza kusema ati maisha na kuchukia sijui CASNEB ni mbaya. At sasa CASNEB, but they want to build another CASNEB towers using your money. No, when do you kushika concept here? CASNEB is a very fair examination body, very fair. Yeah. So then this gives us what here, somebody, and 297,000, isn't it? So this is 297,000. And then we come and less who? We less closing stock. So closing stock, are you able to remember the closing stock units? 2,000, isn't it? And remember, this is a full unit. So we are going to multiply this with 27. 54,000. So this gives us 54,000. So come here and subtract. Combine the three. Now I'm getting used to this. I was really sweating. It is an easy thing. 243,000. 243,000. So you know this is the cost of sale. So you come and subtract this from our sales up there. 72,000. So I'm being given a figure of 72,000. I will be able to move slowly there. So we have 72,000. So what good name are we going to give this 72,000? Gross contribution. No, here you have been able to bring also fixed cost. It's gross profit. Gross profit. Ooh. Gross profit, yes. Gross profit, 72,000. So once we get this gross profit, I want in this case here to get net profit. I want to get net profit. So what do I do? We subtract other costs now. Other non-production costs. You can actually get used to that language. Less other non-production costs. Or less other costs into bracket non-production. Less other costs. But these are non-what here, somebody? So when you hear non-production costs, what comes to your mind? The selling, distribution, etc. But for this question, simplicity, we only have selling. And now there are two of them. Which ones are these? So we have variable selling and fixed selling. Those two only. Variable selling and fixed selling. So we start with variable selling. Variable selling. So variable selling, are they able to remember how we computed this one? 1 times 9,000. Because it's based on the number of units in this case that you sell. So 1 times 9,000. 1 times 9,000, which gives me 9,000, like that. I would want to get feedback from my online students. Are they able to follow? I want to get feedback from my online students. Are they able to follow? I can see so many chats there, meaning that these guys are very, very good. Thank you so much. These guys are very, very good. Are they able to follow? Caroline says, yes, what about the other ninjas? Great. And I'm so sure you are a little bit disturbed because you can't see my face, but don't worry about that, really. The most important thing is for you to understand. So then we have what we call fixed. What here? Fixed selling. So fixed selling, what do we have here, somebody? Ooh. Aha. So then I want to move this a little bit. Yeah. So this one here, yes. This one here was fixed. No. This was variable selling. Variable selling. Then we have the fixed selling. So fixed selling over how much? This is given, isn't it? 2,000, you're right. So then you will be able to come here and subtract this. You subtract this. You give me a profit. 61,000, isn't it? So this is 61,000. And we shall be able to give it a very special name. We call this one profit before. Profit before. Profit before O/U. O/U, absorption adjustment. Absorption adjustment, like that. So this profit before over stroke under absorption adjustment. Najua ni kizungu ngumu hiyo, lakini andika kwanza. Andika kwanza. Profit before over stroke what here somebody? Under. Profit before over stroke what here? Under absorption adjustment. Now from there, come and do me a favor. There are two ways here. Because I've done this before, come and mention there, add over, absorbed fixed overhead. Over absorbed fixed overhead. Andika namna hiyo, tutai understand. Haina noma. Add over absorbed fixed what here? Fixed overhead. Now remember, as you produce, you are absorbing these fixed overheads into each unit. So these fixed overheads, how much are we absorbing into each unit? If you allow me, I'll be able to bring you back to this OAR thing. OAR for fixed production overheads. Fixed production overheads only. So is there somebody who is able to remind us the formula for getting OAR? First of all, OAR stands for overhead absorption rate. So we normally take budgeted fixed overheads over budgeted output. So the budgeted fixed production, you guys had given me a number. What I'm selling, this absorption is only for production overheads. The budgeted fixed production overheads, if I'm not wrong, this was coming to 20,000 per month. Look at your question. 20,000 per month. And we have an average, which is the same as budgeted production units of 10,000. Are they able to remember this really? 20,000 over 10,000, which will end up giving me what here, somebody? 2 per unit. 2 per unit. If I drop my screen here, and then I get to share this one here, my good students, please listen. I'm so sure there must be a way of sharing this. You'll be able to see here that our fixed production overhead, you know, we only absorb production overheads. Fixed production overheads are how much here, somebody? 20,000. And then we happen to be having, ladies and gentlemen, we happen to be having our average or budget production of how many units here, somebody? 10,000. All right. So then if that is the case, I will be able to come here right away and continue with my board. Yeah, I've got an easier way. So the fixed production overheads in total were 20,000 over the budgeted production units, which are 10,000. So this gives me how much here, somebody? 2. So how many units did I produce in total in the month of January? Wait, they are forgotten. 11,000, isn't it? So they absorbed fixed overheads. They absorbed fixed production overheads. Fixed production overheads. Automatically, this will be 11,000 multiplied by what here, somebody? By 2. So we ended up absorbing how much here, somebody? 20,000, isn't it? 22,000, yes. And then, of course, we have the budgeted or the actual. Let's call them the actual fixed production overheads per month. We know it was what here, somebody? It was 20,000. The ones given in the question, which now gives us absorbed were higher. So it's called an over-absorption of how much here, somebody? 2,000. Please listen. Whenever it comes to this over or under, what you do, you know very well that you produced how many units here, somebody? And then, of course, you are absorbing how much here per unit? 2. And then, of course, you know that there is a budgeted fixed production overhead per month over how much here, somebody? 20,000, isn't it? So if you pick up your calculator, 11,000 times 2 minus 20,000, what do we have there, somebody? Boy, they're not talking to me. I'm not the one. 2,000, isn't it? 2,000. So 2,000. So if we come and add this, we shall be able to get now our net profit. We shall be able to get our net profit of 60, what here, somebody? Of 63,000. A net profit of 63,000. A good student will be able to ask Mwalimu, but I understand that this overhead here is over-absorbed. But why are we adding it? Why are we not subtracting it? Because, ladies and gentlemen, you see, this overhead is a cost. It's a cost. And if the cost has been overstated, what effect will it have on profits? If you overstate the cost, the profit will reduce. So to correct the error, you add. What I normally tell my students, because I always like giving students shortcuts, they get to pass. You see, when you subtract here, you're getting a positive answer. So if you get a positive answer, what do you do always? You add. But when you are subtracting here, for example, like now for the month of February, you'll see the answer here is negative. If it's negative, what do? You deduct. So you don't have to keep on making that argument that this is over or under. No. But for now, we know that anytime we have an over-absorbed overhead, what do? We add. I'm so sure you have understood nothing. And even the nothing you've understood it wrongly. But can you kindly do me a favor? I want you to repeat the second P&L, absorbed, ABS, for which month? February. But this time around, I want you to be very serious with your neighbor. Please, let's talk. Because as I told you, you can't avoid. I always tell my students. That is why if you look at last semester here, I mean, the students I had for MA last semester, there were so many, even physical. Nobody failed. But I can't teach you and then you fail. If you fail, know that you have a problem. You have a problem. That one I can guarantee you. And maybe this wasn't your profession, right? You can discuss about other professions, right? So I'm just calling upon you to get a very, very good neighbor. If you see your current neighbor is not talking to you, just move away from that neighbor and look for a new neighbor. Because I want you guys to discuss and do an ABS P&L statement for the month of when? February. Once we finish that, there is no question we can't tackle in the past papers for this topic here. Then we shall be able to say this topic is over. When we meet in our next session, I'll only be looking at the break-even statements, limiting factors, we finish the topic. So now everybody's doing February. In this case here, the students who are at home, I'm so sure you don't have neighbors, but the good thing is that some of you, your spouses are accountants, right? So call them. You get to discuss with them, which is also tragic. An accountant marrying an accountant is very, very bad. We need to diversify, isn't it? Get a primary school teacher. Get a nurse. Yeah. You may not have understood this very well, but trust you me. If all of us are doing this one February, February, ABS absorption for February, we shall become so good in this thing. So how many minutes do I give you? 1 hour? No. 10 minutes, isn't it? 10 minutes is sufficient, yes. So long as you are talking to your neighbor, you do like one figure, and then you get, in this case here, to discuss with a neighbor as I read the chats for my online students. Yeah, great. Thank you so much, admin. Carolina, we are doing, thank you so much, Carolina. We are doing the February, only 10 minutes. 10 minutes. 10 minutes. My clock is not very good, saying 8:36 a.m. It's saying 8:36 a.m. But now when it reaches 8:46, your 10 minutes will be over. Which paper are we doing, admin? Thanks for asking. Let me share the paper. This is the paper that you're doing. It's not a past paper. So I'll be able to. You see this example? Now we are doing ABS, absorption costing, profit and loss statement for the month of February. For the month of February. 10 minutes at most, 15 minutes. And I'll force you guys to discuss. Wacha nianza na wananchi wa online. Wananchi wa online, what figure are you getting in this case here for ABS? For ABS, they are getting, don't forget to share this PDF after the class. Okay, 77,500. 77,500. 77,500. We shall overcome, right? So we can just compare notes just for the sake. I'm so sure you are correct, but we're just comparing notes. Oi, Nick, like which is okay. It's part of the game. Nick, please be very attentive. Now I'm reading the answers. Yeah, so we have sales February 11,500 times 35, which gave us 4,2,500. Opening in inventory is 2,000 times 27. Production cost is 9,500 times 27. Yeah. Closing in inventory is 0. Even that 0 gives you a mark. Yeah. So gross profit, we got 92 what here? 92,000, right? Then we have selling cost, of which variable selling was 11,500, fixed selling was 2,000. Then we have profit before OU, absorption adjustment. That profit is coming to 78,500, isn't it? And then we have an under-absorbed overhead. Under-absorbed, you took 9,500 times what? 2 minus that constant of 20,000, which gave you a negative figure, right? So you subtracted, which ended up giving us what here, somebody? 77 what here? I can only trust you guys if you are able to do the past paper question without my help. There is a past paper question that I gave you, right? If you're able to do it without my help, the better. Do you remember December 2024? December 2024? December 2024? Yeah. Question number 2B. December 2024. Nick, I hope you have gotten something. Nick, 78,500. I hope that was wrong. Ako ameadjust your 1,000, isn't it? Akiadjust aking'oa anaipata. Thank you so much, Nick. Great. So now we are doing December 2024. Question number 2, what year? B. And I want you to combine those 2 months. Do them without my help. Because I will not be there. I will only be doing your exams. It is just the same logic. So long as you just go slowly. If it's sales, you do sales for January. And then sales for when? February, for example. At the same time. December 2024. Question number 2B. And then please don't forget to always be coming here on Sundays for the revision class. So Sundays, we shall be introducing pure revision classes. Where you come here, you do most of the things. Mimi sifanyi kazi. Mimi nitakuwa naangalia tu. Nyinyi mnafanya kazi mingi, but mimi napata mshahara, sawa? Yeah. Alafu mimi na mark, isn't it? So it is normally Sundays at what time? 3, yes. Sundays at 3. If you can come a bit mapema, even the better. Because the MA is a paper, we should be able to pass 1 term, isn't it? Yeah, we are not repeating. Alafu, I'm also so good in these other papers, like audit and assurance. So also, if you create time, I can always assist. Mnafanya audit and assurance? Sure. Ama ushapita tayari. So you see, like, for example, under audit and assurance, I have very good acronyms. Just for you to see what I'm talking about. And all these other papers, hakuna papers in a shortcut yake. Mimi nilipata awards, all of my papers. Hakuna paper sikupata award. Yeah, so let me first of all do this. Great. So you see, for example, if it's audit and assurance, what is audit? Independent assurance, isn't it? Yeah, this auditor is coming in to give an and he has to be independent. For him to be independent, then this guy must really be independent. Asikuwe employee wa company etc. Lazima akuwe msafi, inaitwa service. Lazima akuwe msafi kabisa, inaitwa service. For him to be independent, number one, he should never have what we call self-interest. He should never be an advocate. Yeah, if for example you're an advocate of RCM, always on Facebook you're telling people that RCM is the best, you say automatically you are our friend. So automatically you are attached to us. So in the future you shall never be our auditor. And I'm not saying that you stop marketing us. You should always market us. Because you see, if you're marketing us always, and then you come and start auditing us, and then you get issues within RCM, will you be free to go outside there and say, hey, that school that I was really praising, it's a bad school? Will people believe you? No. Then, of course, in this case here, we have the issues of familiarity. The moment you audit, like in Africa, in Africa, you can audit a company even for 50 years. Wazungu, maximum audit period is 3 years. Because the moment you start auditing us for so long, and then, of course, we happen to be having an issue as an auditor. Perhaps in this case here, my girl is getting into some wedding. You see now the directors of this company will attend that wedding. Yeah, we start getting familiar with each other. If we get so much familiar with each other, then there is no way I'll be able to come and tell the public that these people are bad. So getting used to one another is what we call, so we have the concept of intimidation. If we are intimidated, then you will always be saying that, you know what, these companies' financial statements are truthful. Because everybody fears death. If somebody comes and puts a gun on your head and tells you, hey, give us a good report, then automatically you are not independent, isn't it? Then we have what we call self-review. Yeah, where you are doing some other things for this company, and then later on you'll be called upon as an auditor to look at the same things. You cannot come and tell us. So it will be very important for you to come and, for example, remember what we call the audit procedures. Audit procedures, we have what we call RAEOU. Is there somebody here who has a child back at home? Do you normally teach them these things? Amazing za kitambo. RAEOU, analytical procedures. Ukienda kwa exam yoyote audit, lazima ukumbuke analytical procedures, because nowadays they give you very practical cases. They tell you, assume you are the audit manager, and then you're given a scenario. So this scenario to audit, use these procedures. Ya kwanza ni analytical review. Analytical review, you look at financial statements over many years, compute ratios, discern trends. We have A is inquiries and third-party confirmations. As you audit, you must keep on inquiring. You must keep on talking, for example, to the clients of this company. All right. We have I, inspection of documents. We have observation. And then we have lastly what we call recalculation, and what you're for. At least there is a recalculation. When you come and you're told that this company's financial year 2025 depreciation was 10,000 or 10 million. You can't just trust that figure. As an auditor, you're supposed to be very skeptical. We call it professional skepticism. So you need to doubt every figure you are given. If you're given a figure of tell them, hey, no, give me assumptions, give me your fixed asset movement register, and then you compute depreciation of rent. It's called recalculation. So these are very good things in this case that I need to bring to your attention. So for example, we have what we call management assertions. Management assertions, we normally use the acronym ACCA cover. Very important. Yeah, I'll be able to tell you what are assertions. I'll be able to tell you, for example, objectives of internal control systems, ICS. We normally use the concept of what here, a stop. So if you have got very strong internal control systems, we shall be able to get accurate financial statements. We shall be able to have our assets, in this case here, safeguarded from being stolen. Automatically when you are auditing, everybody in the company is a thief. You doubt them, isn't it? And it's true. Even you'll keep on, in this case here, accusing these ministers outside. But the truth is, it's an opportunity you have not got. If you get like somebody in this case here telling you that as an auditor, please, we are sorry, we have been able to misappropriate 100 million. Alafu wakuambia tujamalize pesa, tuko na 50 million. Wakuambia sasa usikatoseme, let's give you 20 million. Kusema ukweli utakataa. So you see, as an auditor, there are two things, and you will be able to see this in your past papers. You can either become a bloodhound, a bloodhound, or in this case here, you can become, in this case here, what we call a watchdog as an auditor. Two great words here. A bloodhound, a watchdog. So if you have got some dogs here, these dogs, you go hunting with them. If you have a watchdog, you've gone with it to hunt. And in this case, it takes up, for example, a rabbit. If it's a watchdog, it will be able to kill the rabbit. It doesn't eat raw meat. It comes back to you as a hunter, tells you that, you know what, that rabbit is there. Cook it, give something to me, which is cooked. That's a watchdog. How about a bloodhound? It will see the rabbit, eat everything, come back to the hunter with blood in the mouth. So if you are an auditor and somebody tells you there is a 20 million for you here, shall you go back and report to the shareholders that these guys are stealing? They even attempted giving me 20 million. Will you be a watchdog watching over, or shall you be a bloodhound? Let's talk the truth. 20 million and you're seeing a Prado here. You are seeing a yacht in Mombasa. So chances are we shall be what you blood, which is, I mean, quite unfortunate, but that is the truth of the matter. Where did I touch? I don't know. Yeah. So these are things, if you guys can create time, I'll be able to assist you pass these things in one term. Yeah, and so long as you're my MA students, then I'll be able to guide you in some of these other papers, including FR and any other paper that we have. So long as you create time over weekends. So that notwithstanding, have we finished our question? We shall overcome, right? We shall overcome. We shall overcome. We shall overcome. Shall we be able to do? And you see, like, for example, unlike the online students that I'm teaching, the online students currently, they're about 300. I always get questions like sending to me. Yeah, not to me, not to my personal WhatsApp, but in the group. Yeah, for example, I've done this question. Please, Mwalimu, mark. And I always take time to mark. My physical students, I know they are very bright when they are here. We normally talk a lot. They're giving me correct answers, but I've never seen you doing any question. So what I don't know is whether you guys this semester have gotten geniuses of students this semester. It's always important that you identify questions from your past papers, and then you do what you do them, you attempt. You don't have to get them right. Just do them, and then we keep on discussing. Otherwise, I know it's 8 o'clock. I know you've got other things. See you on when? Friday. So the online students, will you be able to attend this session on Friday? The online students, will you be able to attend the continuation of this session on Friday? Or we shall overcome? Let me hear from them. Online students, it's 6 p.m. to 8 p.m. Shall they be able to attend? I send them a link, or they want to wait? Yes, great. So thank you so much. Have a lovely night. See you then. So stop here. Where do I end the meeting?